Thanks for the kind introduction. And as Lisa said, I will talk about something that is based on a recent policy report for the left in the European Parliament and some previous work I have been doing for the European Commission and as well as more academic rather than policy work that I have done previously. And the intentional objective of the webinar is to make sense of the recent food crisis, as well as kind of diving into who are the kind of winners and losers of this. So I hope to be able to provide a narrative of what has driven this crisis, to unpack it a little bit, and also unpack who's actually benefiting from it and what are the broader consequences. So why should we care? Overall, I want to make 5 arguments, and hopefully these 5 arguments will come together to a whole at the end. The first one is that we do have a food price crisis, not a food supply crisis. And again, this is something that I hope to unpack a little bit in a few slides. The next argument I want to make is that the initiation of the food crisis, at least in parts, was driven by financial speculation. And that financial speculation emerged in the anticipation of potential food shortages. And of course, that emerged in the context of the war on Ukraine and has been built up, of course, due to the previous situation of COVID, supply chain crisis, and disruptions. That then built an environment that was accommodating for financial speculation to then emerge into a price bubble. Now, this perception or narrative of crisis was utilized by quite a few of the large players in the food system, so large food corporations that position themselves in different parts of the food chain, if you want. And they have used that narrative in order to increase or achieve exceptionally high markups, which has resulted in record profits being recorded by some of them. The fourth argument I want to make is on the beneficiaries. So who are actually the people who benefit from that, or the actors who benefit from that? And I will make the argument that in a financialized food system in which we find ourselves today, the main beneficiaries of a food crisis, as it was the case in previous food crises, are mainly financial investors, and of course those for whom these financial investors operate. And that leads me to my fifth argument, which is the consequences of all of this. And I will argue that the consequences, of course, are high inflation or a high inflation environment, which was sustained for quite a long period of time. And that has resulted in rising global inequalities, mainly through wealth inequalities, as those who are asset holders have benefited from high returns, while those who are being squeezed by inflation have suffered as a consequence. So let's start with the first argument, which is the argument about a food price crisis and not a food supply crisis. On the right-hand side, you see data from AMIS. AMIS is a data service that came into existence after the 2008-2009 crisis. So the data isn't available, unfortunately not available very long historically, but the idea back then was, and this was the last time that we had a speculative crisis in food commodities, was to never let that happen. So once financial investors have better information about the actual demand and supply of food being available globally, then that in theory should prevent speculative bubbles to build up. Now, this hasn't quite worked, as we can see in the most recent situation. But what the data reveals, and you can have a look at if you look at the top bar, the green line is basically demand, or what has been used in terms of food globally as an aggregate. The dotted black line is what has been produced in different years, and the blue line is basically closing stocks. So whenever there has been a year where there's an excess production over what has actually been used, then stocks are building up, and vice versa. And we can see that the only year where really demand has outstripped supply was 2018 and 2019, but actually quite a good amount. And we have seen in that year that, yes, grain prices, so in this case, we're looking at wheat, grain prices have increased, but the increase was quite moderate, actually. But if you look at the most latest food price spike or the price spike in wheat prices in like early 2022 up to mid 2022, this is not something that has been supported by an actual shortage in global food. So we see a massive increase in food prices, much steeper and much higher than what we saw when there was an actual shortage. I mean, not shortage in the sense that we didn't have any stock left, but shortage in the sense that stocks were actually declining that particular year. So that gives at least an indication that actual demand and supply might not be the full story in this context. So at no point since the war in Ukraine or on Ukraine has actually started did we have an actual shortage in wheat. And indeed, we had a bumper harvest recorded in 2022 and 23. And once that information came through, then that price bubble burst. So you can see the peak and then a very steep decline of prices. Now, part of that story, of course, is rising costs. And costs have increased, or cost of production in food commodities have increased quite steeply due to rising costs in fuel and fertilizer. So one is to transport and, of course, the other to grow food. So this is a similar figure than the one we had on grain, but now here we're looking at something that's called N fertilizer, and N fertilizer is produced from natural gas. So the price of N fertilizer is tied almost 1-to-1 to natural gas, and the thick line that rises very steeply towards the end, so in 2022, that's the actual export price of N fertilizer in that year. The dotted lines are again demand and supply, and the bars at the bottom show you the difference. Now we can see that we have had an excess production of N fertilizer throughout, actually with an increasing excess supply since 2013. So again, while of course the price in fertilizer and the price in production has probably played a role in the actual steep increase in food prices over that period of time, the root causes of that steep increase in the cost of fertilizer can also not be explained by actual demand and supply or actual shortages as in fertilizer, which has never really materialized on a global scale. So for both of these phenomena, there has to be an alternative explanation for why prices have skyrocketed at that period of time. And of course, it's linked to the Ukraine crisis. But my argument is that the Ukraine crisis has not actually resulted in a shortage of N fertilizer or a shortage in wheat, but it was the anticipation of a potential shortage that has facilitated the price rise or fed into this speculative bubble. The overarching question we should ask ourselves, why does this actually matter? If you remember the price index that I showed you at the second slide on wheat prices, this was actually the price of a futures contract. So that's the Kansas City wheat futures contract. Now, if you're looking at futures contract, why should we care? Why is that important for the actual price of wheat? And this is why this is relevant. Now, global trade in most staple foods, including wheat or corn and other food commodities, are benchmarked against commodity derivative markets or these futures prices that I just showed you. So what you will find is that if you're talking to importers and exporters of that wheat, what usually is written in these contracts is that the price for which this wheat is being exchanged is exactly the price that is being traded at the futures exchange, plus maybe some premium that accounts for quality and location and so on and so forth. Now that means whatever is happening at the futures exchange has an immediate consequence for the actual price of the physical commodity. So it is important. Now, what's a futures exchange? In itself, it's an exchange for contracts rather than the physical commodity. So what you have is a contract that gives you the opportunity to buy or sell that physical commodity at some point in the future. Now, the actual futures market doesn't facilitate any physical trading, and actually physical trading rarely happens. Usually you'd close your contract before you would actually have to deliver that commodity or take ownership of the underlying commodity. So these prices that you see on futures or derivative markets do reflect demand and supply, but they do reflect demand and supply for these contracts, which are different from the actual physical commodity. And there are different reasons why mainly financial investors might want to demand or want to open or own such a contract. So for instance, some, which would usually be referenced as active traders, might have an expectation about the future worth of a commodity. So if they think that in the future there might be a possible shortage and they want to benefit from that shortage and the resulting price rise, they will heavily bet on rising prices. Now, there are other traders, which usually are referred to as passive investors or institutional investors, which don't care so much about the actual commodity, but they want to get hold of a portfolio of different commodities in the same way as you would invest in an index stock, right? So we're all familiar with indices for equity, and commodity indices work in a very similar way. So you might want to diversify your portfolio, and for that reason, you're investing in commodities in order to get a broad-based exposure to different commodity prices. Although you don't have a particular view on a specific commodity or are particularly interested in any of these commodities. The third reason might be for hedging purposes. So if you're someone who's actually holding large inventories of the physical commodity and you are worried that the actual reference price for that commodity might decline in the future, you can take an offsetting position in the derivative market and thereby lock in the price at the point in time where you think the price is actually favorable. Now, any trade on derivative markets is highly leveraged, so traders are never required to actually put down the full value of the commodity they are trading in, but they usually position a percentage, let's say 10%, in something that's called a margin account. And all those of you who have maybe watched movies about the 2008-2009 crisis, The Big Short, for instance, the story was about margin calls, and these operate in exactly the same way in commodity derivative markets. So you have a margin account in which you deposit some of the security deposit, and if you're betting on rising prices and the rising prices materialize, then you get some credit on that account, and if the price is actually falling, then you get some money deducted. So that's how it actually works. Now, all trades in commodity derivative markets are speculative in nature. Every trader, even those who are hedging or using these markets to hedge, they are forward-looking. They take a view on the market. No one would hedge if they think that the price, or if they are certain that the price will move into their favor. Then if they were to hedge, they would be stupid, because they would lock in a price that would actually be lower than the one they would be able to achieve. So everyone in a commodity derivative market, in a way, speculates, because these markets are forward-looking. You're taking a position with the expectation of a future gain from that particular position. Now, the right-hand side is a graphic that shows you so-called short and long positions at the Wheat Chicago Board of Trade for what they call in the report money makers, but these are hedge funds, active traders usually. And we can see if we compare the different bars that are highlighted, so these gray bars, the top ones indicate the points in time when the positioning of these hedge funds or active traders has changed, and the bottom one maps this against the price dynamics that we have observed earlier. And what we can see is that at the onset of the Ukraine crisis, so in early 2022, we see that those short traders go down and the long traders go up. So what are short and long traders? Short traders are those who are actually gaining from falling prices. So you're betting on falling prices. If prices are falling, you're actually making money. Long traders take the opposite view. Long traders are gaining from an increase in prices, so they're betting on increasing prices. So you can see that you have an increasing amount of traders who are betting on rising prices. At the same time, those who have been betting on falling prices in an already rising market, because that's the post-COVID period, and that's important. So it was already a quite destabilized environment where you had supply chain disruptions, where COVID has disrupted a lot of the global trade. So it was already an environment of high levels of uncertainty. And that period where we have these long traders betting on rising prices coincides exactly with the emergence of the price peak or the price bubble that we see at the bottom. Now, the moment when it became clear that a bumper harvest was announced in the summer of 2022, that was when actually the positioning reversed. And you can see the blue lines of the long traders exited quite strongly, while an increasing amount of traders were actually betting on falling prices. And that's what brought down, in the end, the price bubble. And at some point, we had a massive collapse of prices, which are mirrored in a large amount of active traders heavily betting on falling prices, then further accelerating the price collapse that we see in kind of mid-2023. Now, well, this is, of course, just correlation. So we're mapping these onto each other. It doesn't say anything about causation. And there's evidence from previous food crises that actually these speculative positioning does play a role in the price formation, because in the end, this is the demand. What you see at the top is the actual demand and supply for these derivative contracts, which of course underpin the price for these contracts. So the argument here is that it's speculative positions who have contributed to the price boom, and these speculative positions were taken in an anticipation of a possible shortage from which these traders wished to benefit. Now, that didn't materialize, and we had a bumper harvest instead, which then reversed the expectation, and traders were then betting quite aggressively on falling prices instead. Now, how we can see that this bubble has burst already quite a while ago. Still, we're seeing very high levels of inflation materializing throughout and being sustained since then, coming down a little bit in different countries now. How is that possible? So how and is it possible that the price bubble, yes, we have seen a high rise in food prices, but also a collapse in food prices. But clearly the collapse in food prices wasn't passed on to consumers in the same way as the increase in food prices was passed on. At the same time, there were a lot of headlines in recent months and past year about record profits being generated by different food corporations, and mainly in the spotlight were grain traders, so large food trading houses like Cargill, Archer Daniel Midland, Louis Dreyfus, and the likes, as well as branders such as Nestle, so these who are actually producing branded food stuff. So how was it possible that these actors were generating such high profits when presumably their costs were increasing quite dramatically as food prices were going up, right? So these grain traders are people who are buying food as much as selling it. The branders are also buying food in order then to produce the food. So how were they able to achieve such high levels of profit? And this is related to a story that combines the concentration of these different segments in the food chain with a corporate strategy which was played by these corporations in previous food crises as well. we had an already very uncertain, destabilizing environment coming out of COVID, having continuous supply chain disruptions, and a very nervous market. And then in that environment, the Ukraine crisis happened. Now, that perception of crisis and a narrative of possible shortages that would materialize have then been used by these food corporations to legitimize an increase in sales prices. And this increase in sales prices went far beyond what would have been required to actually cover their costs. And this is something that we see across, especially the food trading corporations, who had, again, on top of this, an additional stream of income, which I will come to, but also the branders, like, for instance, Nestle. So these high markups really resulted then in exceptionally high profits. And some of this strategy is reflected, for instance, in a quote from George Weston, who's the CEO of Associated British Food. And that quote was made in a speech that he gave to investors at the firm's annual results presentation. So he was basically talking to shareholders. And he said or explained that revenues benefiting from price increases and operating profit was solid. We had to recover a huge amount of input costs from consumers or customers that don't like giving you price rises. And we have done that job really well, but it's not finished. So they're bragging about the fact that they have been able to roll the increase in cost over to consumers almost, entirely and more. So the promise of this is not finished means that they still have a positive view on being able to pass on more cost or increase sales prices even further. And we can see that strategy. So this is just on the example of Nestle, and in the trading houses, this is even more clearly depicted. But we can see this strategy, which is a common strategy across all corporations, of a matching of percentage increases in costs with percentage increases in revenues. And that's true both when costs are declining and when costs are going up. Now, at the last part, so this is the bit that we are interested in, we might also be interested in the story during the last really big food price crisis in 2008, 2009. We have seen in the build-up of that price rise, which came to complete collapse in 2008, Nestle was similarly benefiting. So that's the first black circle there. The second black circle is the recent food crisis. So what happens is that this percentage cost increase maps the percentage revenue increase, so that's your sales price, very, very closely throughout. Now, what happens if you have a positive difference between costs and revenues to start with? So you have positive profits at a particular point in time. If your costs increase by 10% and you increase your sales prices by 10% as well, the markup between the two will also increase by 10%. I do invite you to do that calculation on your own, but it's a simple percentage calculation, right? The difference between the two is in levels. The difference between the two, if you increase the cost by 10%, you increase the sales price by 10%, then your profits are going to increase by 10% as well. So if you are able to match the 10% increase in costs by 10% increase in sales prices, you will have an increase in profits. And that's exactly what these corporations have done during the past crisis. Now, this has been dubbed in the literature, including Weber. Isabella Weber has been probably the most famous for starting the debate, has been dubbed seller's inflation, because that's inflation that is not caused by an excess amount of money in floating around, which is the standard kind of monetary policy narrative, and the reason why central banks usually in response to a high inflation environment raise interest rates in order to get the excess money out of the system. But it's inflation that is being caused by large corporations who have a relatively strong market positions being able to push sale prices up to their benefit. And that's beyond what they would need in order to just cover the increase in costs. Now, who is benefiting from all of this? And in order to finish the story of who are the beneficiaries, we need to understand how the food system, or our current food system, does look like. And there's a broad literature about the financialized food system, and I don't have time to go into a lot of detail, but the figure here is to show you to what extent food corporations and financial corporations are intertwined. So on the top side, you see everyone who would be, the different stakeholders who would be located across the food chain. So that's agri-input providers, farmers. Thirsty suppliers are the large trading houses, branders, that's Nestle, retailers, that's your Tesco supermarket, and then, of course, us as consumers. And at the bottom, you have different financial actors that could be index funds, institutional investors, hedge funds, asset managers, investment banks, private equity, and so on and so forth. So how do these players actually interrelate? Now, a lot of the branders, retailers, and also some of the thirsty suppliers are publicly listed companies. That means their equity as well as their bond, so their debt, is being owned by financial investors as well as other corporations in the business. They themselves, of course, buy a lot of or buy and sell shares, so they might actually take over competitors by mergers and acquisitions and buying their share. Now, at the same time, and that's specific to the food system, we have thirsty suppliers who are registered as non-financial corporations who are actually acting in parts as financial corporations. And the same is increasingly true for retailers, so for your supermarkets. Now, thirsty suppliers are very active participants in commodity derivative markets, which would be the realm of the financial chain rather than the food chain. So they are one of the market makers in these markets. At the same time, they're providing insurance services or offering insurance services to farmers or other downstream and upstream customers of theirs. Now, retailers have increasingly moved into banking services for customers as well. So a lot of retailers are offering credit cards and credit services to their customers as well as insurance. And all of these are financial instruments. So they are increasingly entering into the financial sphere of things by extending these services. At the same time, we have these financial corporations who are slowly merging into or taking more and more exposure of the food, the actual kind of production, trade, and consumption of food. So some few of them actually own or invest heavily in land or the actual physical crop. That's are quite a few, only a few who actually own the physical crops, but most of them seek exposure to physical food prices through active trading in these food derivative markets, or betting on land in form of either equity or private equity. So we have these financial investors who are seeking exposure either directly to food prices by investing in food derivatives or food indices, and or indirectly through investing or shareholdings of these thirsty suppliers, branders, and retailers. And at the same time, thirsty suppliers, branders, and retailers are acting both as non-financial corporations, but increasingly also as financial corporations, being quite active participants in some of the derivative markets. Now, this is to keep in mind for our dissection of who benefits from the food price crisis that we have seen over the last couple of months. The first beneficiaries are financial speculators. And of course, financial speculators do gain from a high level of volatility in prices. So the steeper or the larger the increase or decrease in a price over a short period of time, the larger the possibility to gain from that increase or decrease over that period of time. Of course, also the larger the possibility to make huge losses. So it's a risky game. But speculators overall have an opportunity to gain a lot of money in a very volatile market. And on the right-hand side, this comes from the policy report, is a back on the envelope estimation for speculators in the Paris wheat market. Now, the Paris wheat market is really small compared to Chicago wheat, for instance, or Kansas wheat, which we looked at earlier. But since that report was for the European Union or for Europe, we took the Paris wheat market. Now, on the Paris wheat market, we estimated what are the amount of positions that are betting on rising prices, so would gain from rising prices, and what are the amount of positions that are betting on falling prices and would gain from falling prices. The net gains are depicted in the blue line. And of course, this is a back on the envelope calculation because we don't know how many new positions are being rolled over. So there could be a lot of selling and buying in the interim. Now, the cumulative earnings between January 2020 and May 2020, which was the price peak, which is depicted as the orange line, amounted to about 22 million euros. Again, it's a very small market compared to Chicago wheat or Kansas. Now, with the collapse of the price, a lot of these speculators were caught quite by surprise, and you can see quite a massive amount of losses. So these are the ones who hold on to long buying positions and lost out on these positions. Relatively quickly, traders then reverted and the short positions outpaced the long position, as we have seen earlier, and therefore the cumulative profits were increasing again as traders were increasingly benefiting from the falling prices which they were betting on. Now, the people who are actually holding these positions, or if you look at who is behind these so-called speculators or speculative positions, this group contains mainly asset managers, hedge funds, and investment banks as a group of traders that are active in these markets. Now, the next group of beneficiaries would be the large food trading houses. So we already seen that they have recorded excessively large, or very large, excessively is a difficult word, but very large profits over that period. Now, some of these profits don't stem only from having been able to match the percentage increase in cost with the percentage increase in sales prices, but also from their financial speculative activities. And the right-hand side is a quote from the annual report of Archer, McDaniel and Midlands, one of the few large trading houses that is actually a listed corporation that has to give a shareholder report. Now, what they say is that the majority of the company's derivative instruments have not been designed to as hedging instruments. The company also uses exchange-traded futures and exchange-traded over-the-counter options contracts as components of merchandising strategies designed to enhance margins. So what they say here is that they're using these derivative instruments, so these are the ones that are traded on these futures exchanges, partly to hedge, but mainly in order to get additional revenues through speculation. And these trading houses have always done this. Of course, as other speculators, they can make a lot of money in times of high levels of volatility. They even better equipped to position themselves as speculators because given the high level of market concentration, they have an enormous information advantage when it comes to actually knowing what's going on in these markets, and therefore having a very good way of positioning themselves in particular points in time in these markets. So speculation is one of their core activities or operating activities. Now, ADM, in the time when they announced this, had recorded the highest operating profits in its history for 2 consecutive years, with $4.8 billion and $6.6 billion respectively. And a large part of these profits are generated through speculation. So they are main beneficiaries on both the financial side and the physical side. The other group of beneficiaries are shareholders and bondholders. Now, shareholders of the listed corporations, especially the The founders, who majority publicly listed companies, are rewarded either through dividend payouts or share buybacks. So share buybacks are operations that are being conducted by companies in order to artificially increase the value of their shares. It's forbidden in some regulatory environments and legal in others. Nestle is listed in Switzerland, where this is perfectly legal, as well as it is the case in the US, for instance. Now, Nestle disbursed a total of 22 billion to shareholders and debt holders together in 2022, which was in excess to its extremely large profits, but in excess of 4 billion US dollars above what the actual profits were in this particular year. Now, this is possible because these share buybacks are financed through the accumulation of excess cash through the previous years, and you can see the years before when the bars were below the operating profit line. So these then kind of floating cash is then dispersed to shareholders through these share buybacks. Now, the beneficiaries of all of this are the owners of these shares, of course, which to a large extent for Nestle and other food corporations are investment advisors, hedge funds, asset management firms, so the same people who are also actively speculating in commodity derivative markets. A smaller group, about 12% of the owners of non-restricted shares are so-called institutional investors. So these are sovereign wealth funds and pension funds. So that's a small and growing group of beneficiaries from these payouts. So all of these profits that these corporations have generated on the back of arguably consumers who had suffered through high levels of inflation are then dispersed to financial investors through, as shareholders or bondholders of these corporations. Now, so that means these profits that are generated through the high markup are extracted into financial markets almost exclusively for the publicly listed companies. For privately owned companies, usually these are being paid out in forms of dividends to the owners, who are high wealth individuals or high wealth families, who commonly then channel these payouts through holding companies into tax havens. And there are a couple of, Louis Dreyfus has been in the news quite regularly over the last couple of months for that. Now, parts of these profits are also extracted through interest payments to bondholders or debt holders, which would be banks as well as investment banks as well. So a very similar group. Now, the owners of these shares and bonds are the BlackRocks and Vanguards of this world. That's not very surprising. And they're also the ones that tend to speculate in commodity derivative markets, hedge funds and wealth funds of these types. That means financial investors are the main beneficiaries, and they benefit both directly and indirectly from these high and volatile food prices. So by direct speculation in food derivative markets, but also through exposure to the companies that are producing food or processing food. What does this mean, and why should we care about this? So why should we care in any way about these guys making a lot of money? Well, we should care because what is driving a lot of the growing inequality, especially wealth inequality that we see, whenever there's a crisis, there's a push when it comes to global inequality, especially wealth and asset inequality, is driven by exactly these dynamics. We have a very high inflation environment, which means that those with a very relatively low income see their disposable income squeezed. If you have disposable income squeezed, your savings goes down, so the ability to actually invest in something that would be high yielding is down or even negative, which means for many, if they squeeze below a certain threshold where their disposable income de facto becomes negative, they have to take on debt. If you have a high inflationary environment, interest rates usually go up because the central bank has to adjust interest rates in order to curb inflation, as it is its mandate and the only tool that it provides itself with. These people are not only thrown into debt, but they're thrown into very expensive debt. On the other hand, we have those who are actually having a lot of wealth or having a high level of disposable income so that they can actually invest in high yielding assets. They're seeing an enormous return on these assets. So those who have a high level of wealth see enormous increase of that wealth through these 20%, 30% increase in profits and the returns they get on these investments that they're making as they're being paid out to shareholders and so on and so forth. And at the other end, we have those who are being increasingly squeezed as a result of high levels of inflation and rising interest rates. This is from the latest report I could find on global inequality from 2022, which recorded that, and I'm not an expert on global inequality, so there might be more recent figures. I'm looking at my colleagues for help here. But in that report, it stated that the top 1% or the top wealthiest 1% of the global population own 38% of global wealth, which is an incredible amount of money and incredible inequality, and of course outpaces income inequality. So yeah, we should care, and this does matter. So to conclude, we have found that the food price or the food crisis was a food price crisis rather than a food supply crisis. This has resulted in a high inflationary environment across the world, which has led to central banks responding adequately is a difficult word. There would be other ways of responding, but responding by rising interest rates, which all the adverse consequences that we have seen, recessionary pressure, increasing risks of debt crisis, and actually materializing debt crisis across the world. We have also established that speculation has at least played a role in these food price increases. Saying that we don't have a local shortage in food supply doesn't mean that there weren't local shortages in food supply. And indeed, and this is something that we have seen in previous food price crises, what happens when prices go up is a general trigger of panic and worry, especially by countries which are net importers of food, because they worry that they cannot provide the food they need in order to feed their population. As a response to the last food price crisis, 2008, 2009, again 2010, we saw a lot of countries who might be net exporters at a time stopping and prohibiting exports altogether, and this time was no different. So China, for instance, temporarily suspended the export of fertilizer in the wake of exploding prices of fertilizers globally. Also been accused of hoarding wheat and filling that in order to fill their domestic inventories. I'm not sure you can really accuse a country for doing that, as you have an obligation to your citizens. India, as in previous crises, has also suspended its rice exports to its neighboring countries in order to control domestic inflation. Now, food prices are incredibly important for political stability, and therefore countries are rightly worried about both the availability and the price or the affordability of food in their own borders. Now, this panic reaction often then, in a self-fulfilling manner, validates the expectation of the speculators in the first place, who were speculating on food shortages. And that can then result in a speculative spiral until news such as a bumper harvest come in and the bubble then bursts. Now, this also doesn't, the fact that speculators have driven the last price bubble as in previous times, it does not mean that there's no risk of global food shortage at some time in the future. It just means that the current one or the latest one was a price crisis, not a supply crisis, as the undersupply or the actual physical shortage has never materialized in that period of time. Now, this perception of crisis and the worry and the narrative of possible shortages, the narrative of supply chain disruptions, increasing costs for corporations has then been used by these corporations to legitimize increases of their sales prices and thereby generating very high levels of profit. It has been made possible by high levels of concentration at different segments, especially the brander segment and the food trading company segment. These profits have been extracted into financial markets, usually via shareholder payout or interest payments on corporate debt. And the ultimate beneficiary thereby of all of these activities, both the speculative food bubble as well as the high profits that are being generated by these corporations, are the financial investors who have invested or speculated on these derivative markets, as well as extracted the profits from these corporations. This group of players is dominated by the large asset traders and wealth managers, which again is not surprising. They often either trade on their own behalf or manage the wealth of high wealth individuals. The consequences of all of this, of course, is that we had localized shortages due to the export bans that were imposed and due to precautionary hoarding of different countries, a growing unaffordability of food, which causes malnutrition or undernutrition in different areas and different groups of populations, and a growing level of global inequality, for which the data, I think, will continuously come in this year and next year to see the full extent of the consequences of this high inflation environment, paired with high level of debt and high level of profits by the food corporations. Now, this is all for me.